The future of XRP won't be decided by social media hype or by what retail investors are doing. Its path is being carved out by critical moves happening right now within the world's most powerful financial institutions. While most people are busy watching the price, they're missing the seismic shifts happening behind the scenes. These shifts are happening in regulation, in the infrastructure of central banks, and in the very plumbing of institutional finance. In this video, we're going to break down exactly what these developments are and how they are converging to shape the next chapter for this digital asset. We'll connect the dots between dense policy documents, major legal battles, and the multi-trillion-dollar wave of institutional money that is, for the first time, getting a green light. This isn't about wild speculation. It's about following the smart money. And right now, the signs point to a fundamental rethink of what XRP represents to the global financial system. Stay with us as we unpack the three pillars that will determine everything. For nearly 5 years, a dark cloud hung over XRP. The lawsuit filed by the U.S. Securities and Exchange Commission in December 2020 was a genuine threat. It wasn't just a headache for Ripple. It was a battle for the future of the crypto industry in the world's largest economy. The question was simple but profound. Is XRP an unregistered security? For years, this uncertainty acted like a lead weight on its price, and more importantly, it kept cautious, compliance-driven financial institutions on the sidelines. Banks and asset managers couldn't risk touching an asset that their primary regulator might declare illegal. But in 2025, the fog began to lift. In August 2025, the marathon legal battle came to an end when both Ripple and the SEC dropped their appeals. Although a settlement to reduce Ripple's civil penalty from $125 million was later rejected on procedural grounds, the core ruling from 2023 now stands as the final word in the case. That final judgment made a crucial distinction. While some past institutional sales were deemed security transactions, the sales of XRP on secondary markets, the way most people buy and sell it, were not. Let's be clear about what this means. This wasn't just a slap on the wrist. It was the firing of a starting gun. For the first time, U.S. financial institutions had meaningful clarity. The specific legal risk surrounding XRP was no longer just a matter of speculation. It was defined by a judicial ruling in a key district. The very thing that kept Wall Street on the sidelines had been significantly reduced. While the U.S. still lacks a comprehensive nationwide framework for all digital assets, this case-specific clarity for XRP is incredibly powerful. It carved out a unique position for the asset, setting it apart from thousands of other tokens still stuck in regulatory limbo. Think of it like this. For years, XRP was a high-performance race car stuck in the garage because the rules of the road were a mystery. With the case finally over, not only was the car allowed onto the highway, but its lane was much more clearly marked. Risk managers at major banks no longer had to operate on guesswork. The legal clarity provided by the lawsuit's conclusion was the first, and perhaps most crucial, pillar to fall into place. It was the foundational event that made the next two pillars possible, transforming XRP from a purely speculative bet into an asset that institutions could seriously consider. Now, let's turn to the second pillar, which is unfolding on a global scale: the rise of central bank digital currencies, or CBDCs. This isn't some niche crypto trend, it's the next evolution of money itself. Over 130 countries, representing more than 98% of global GDP, are now exploring a CBDC. They're doing this to solve a very real problem. Our current financial system is slow, clunky, and expensive. Every day, roughly $7.5 trillion moves across borders through a patchwork system of correspondent banks that hasn't changed much in 50 years. It's slow, it's opaque, and a simple international payment can take days, with every intermediary taking a cut along the way. Central banks see CBDCs as a potential solution. A digital euro or a digital dollar could make payments instant, but this creates a new challenge. How do all these different government-backed digital currencies talk to each other? A world with dozens of disconnected CBDCs could be even more fragmented than what we have now. You can't just send a digital dollar to a digital euro wallet without some kind of bridge. This is where the opportunity for a neutral, efficient bridge asset comes in. And that's precisely the role Ripple and the XRP ledger were designed for. The XRP ledger is an open source technology that can settle transactions in 3 to 5 seconds for a fraction of a penny. It was purpose-built to be a settlement layer for value. For years, this was a compelling theory. Now, we're seeing it put into practice. Ripple is actively working with central banks and governments around the world with publicly announced pilot programs in countries like Bhutan, Palau, Montenegro, and Georgia. Ripple has also participated in the Hong Kong Monetary Authority's eHKD CBDC pilot, where it demonstrated a real estate asset tokenization solution. These aren't just press releases, they are sovereign nations and financial authorities testing the technology to solve real-world payment problems. Let's be precise about the role a technology like the XRP ledger could play. Central banks are unlikely to run their entire CBDC on a public blockchain. Instead, many are building their own private ledgers. The challenge of interoperability, making these separate systems work together, remains. This is where a neutral bridge asset becomes a powerful tool. Instead of a slow, multi-day correspondent banking process, a bank could theoretically swap its domestic digital currency for a neutral asset like XRP, send it across the ledger, and have the receiving party swap it for their currency, with the whole thing settling in seconds. This potential utility could create a profound demand for the asset that's completely separate from market speculation. For a bridge asset to work at scale, it needs deep liquidity. The more transaction volume that flows through these corridors, the more liquidity is required. This is no longer a futuristic vision. It's a strategic chess game being played by the world's most powerful financial institutions, and technologies like the XRP ledger are positioned as a key piece on the board. If regulatory clarity was the spark, and CBDC development is the map, then the third pillar, the arrival of spot XRP ETFs, is the potential rocket fuel. For years, institutional investors had no easy, regulated way to get exposure to XRP. They could try to navigate crypto exchanges and self-custody, but for most large asset managers and pension funds, that was a non-starter. The problem wasn't a lack of interest, it was a lack of access. Spot exchange-traded funds, ETFs, solve this problem. An ETF is a vehicle that trades on a traditional stock exchange, like the NASDAQ, but holds a physical asset, in this case, actual XRP. It lets anyone with a brokerage account buy into XRP as easily as buying a share of Apple. While the US has not yet approved a spot XRP ETF, the conclusion of the SEC case has paved the way for multiple applications from huge players like Franklin Templeton, Grayscale, and Bitwise. Reflecting the pent-up demand, US spot XRP ETFs began launching in November 2025, with CBOE approving a fund from 21 shares in December. The market's reaction was astonishing. In less than 4 weeks, these new XRP ETFs collectively attracted nearly $1 billion in assets. As of early December 2025, total assets have surged past $1.2 billion, with some days seeing zero net outflows, a signal of relentless buying pressure. This made XRP the fastest growing crypto ETF to hit the billion-dollar milestone since Ethereum's launch. Let's analyze what this really means. First, it creates a massive and continuous source of buying pressure. Every dollar that flows into an ETF like those from 21 Shares or Canary Capital requires the fund manager to buy real XRP on the open market and lock it away in custody. This is a direct removal of supply from the available market. Second, it dramatically deepens liquidity. With major institutions now acting as market makers, the XRP market becomes more stable and efficient. This is exactly what's needed for XRP to fulfill its utility as a settlement asset. Banks using Ripple's payment solutions need to source large amounts of XRP instantly without causing wild price swings. The deep liquidity from the ETF ecosystem helps make this possible on a scale we haven't seen before. Third, it's a powerful validation signal. When a legacy titan like Franklin Templeton puts its name on an XRP product, it tells every other financial institution that the asset is ready for prime time. It's a stamp of approval that erases lingering doubts. This is the institutional herd arriving, and the early data shows they are arriving in force. So what does this all mean for you? We've connected the dots between the landmark legal clarity, the strategic positioning of XRP in the future of central bank money, and the unprecedented wave of institutional capital now pouring in through spot ETFs. We believe these three pillars are not separate events, but a deeply interconnected sequence that is fundamentally reshaping XRP's future. If you found this deep dive analysis valuable and want to stay ahead of the curve on how institutional forces are shaping the crypto market, make sure you subscribe to the channel and hit that notification bell. We're committed to bringing you data-driven insights, not social media hype. We also want to hear from you. Do you believe this convergence is creating a powerful new era for XRP? Let us know your thoughts in the comments below. To wrap it all up, the narrative around XRP has fundamentally shifted. What was once a story of speculative potential and legal drama has become a story of institutional adoption and real-world utility, driven by three powerful interlocking forces. First, a major regulatory battle is over. The conclusion of the SEC case provided the legal clarity that was essential for any serious institutional involvement in the United States. Second, the global chess game of central bank digital currencies is accelerating. This positions technologies like the XRP ledger as a strong candidate for the kind of neutral, interoperable bridge needed to connect dozens of sovereign digital currencies. And third, the floodgates of institutional capital have been thrown open by the launch of multiple spot XRP ETFs in the US, which have seen a historic near billion-dollar influx in a matter of weeks, creating a supply crunch and providing deep, stable liquidity. These are not independent trends. The regulatory clarity enabled the ETFs. The liquidity from the ETFs makes the CBDC use case more viable. It's a positive feedback loop where each pillar reinforces the others. We are witnessing the transition of an asset from the fringes of the financial world toward its core. The decisions being made in the boardrooms of central banks and on the trading desks of Wall Street asset managers today will echo for years to come. The era of pure speculation is giving way to the era of integration. And for XRP, that chapter is just beginning.